Hello! Today we are going to learn how to get $1,000 a month in dividends. Take it away!
What would you do with an extra $1,000 paycheck each month? Would you pay down some debt? Would you make some much-needed repairs on your house or car? Or would you reinvest it so that it can grow into more income? In this video, we're deep diving into Warren Buffett's dividend strategy that could earn you $1,000 a month in passive income. But that's not all. We're also going to reveal how you can fast-track this process to start receiving your $1,000 monthly dividends in the shortest amount of time possible. Before we jump right in, first, let's take a look at Warren Buffett's absolute investing rules. Rule number 1, never lose money. This may appear obvious, as no investor begins with the aim of losing their hard-earned money. However, circumstances can occur that make an investor overlook this principle. Therefore, Buffett strongly advocates for rule number 2. Rule number 2, never forget rule number 1. Buffett is referring to the mentality of a prudent investor. Avoid recklessness, refrain from speculating. Don't approach an investment with a nonchalant mindset that losses are acceptable. Stay knowledgeable. Conduct your research. Rule number 3, pick businesses, not stocks. Buffett believes that if a company performs well, its stock value should correspondingly rise over time. He looks for businesses with promising long-term potential when selecting investments. Does a company have a stable operating history? Does it possess a leading business franchise? Is the business producing high and sustainable profit margins? If the company's stock price is trading below the anticipated future growth, it could be a stock that Buffett might be interested in owning. Now, let's get into the good stuff. It's no secret Warren Buffett loves dividend-bearing stocks. Of the 49 stocks in his portfolio, 31 of those stocks bring in dividends. In fact, Berkshire Hathaway, Warren Buffett's investment company, is set to rake in a whopping $6 billion in dividend earnings in the next 12 months. So what exactly are dividends? In the simplest terms, dividends are a portion of a company's earnings that are paid out to shareholders. Think of it as a share of the company's profits, a thank you from the company for investing in them. In fact, from 1930 to 2022, dividend income has played a huge role in the S&P 500's index performance, contributing a substantial 41% on average to the total return. That's nearly half the returns coming from dividends alone. So let's break this down. How do dividends actually work? Well, a company earns profits through selling a product or service. As you technically are part owner of the company, through the stocks you own, the company will pay you out a small percentage of those profits to you in the form of dividends. The more shares you have in a company, the more dividends you will receive. These payments can be in the form of cash, additional shares of stock, or other property. Cash dividends are the most common, and they are typically sent to you either by check or direct deposit into your brokerage account. Dividends are typically paid out quarterly, monthly, or semi-annually. Now, it's important to note that not all companies pay dividends. Some prefer to reinvest their profits back into the business to fuel growth and expansion. So, how do you select stocks that pay dividends? First, you should look for companies that not only demonstrate long-term profitability, but also have an anticipated earnings growth rate anywhere between 5 and 15%. Remember, bigger isn't always better in this case. Companies exceeding 15% tend to experience earnings disappointments here and there, which almost always affect the stock price. Next, you should strive to find companies that have sufficient cash flow. Healthy cash flow is important as it can negatively affect a company's ability to pay out a dividend. Finally, a company should have a 5-year minimum track record of paying out strong dividends. You could research individual companies yourself or simply invest in the same companies Warren Buffett does. Here are the top 6 companies that Warren Buffett invests in: American Express, Kraft Heinz, Chevron, Coca-Cola, Bank of America, and last but not least, the biggest one being Apple. In fact, of Buffett's massive portfolio, 49% of it is Apple. Diversify. Diversify is a strategy where you spread your investments across various types of assets, limiting your exposure to a single one. This approach is meant to smooth out the ups and downs in your portfolio over time, helping you to potentially reduce risk. Long-term approach. Buffett is well known for his enduring investment strategy. He once said, "Our favorite holding period is forever." The perspective is particularly beneficial when dealing with dividend stocks. Over time, dividend income has the potential to compound, especially if you choose to reinvest those dividends. Reinvesting dividends back into your portfolio can create what's known as a snowball effect that can significantly enhance your income in the future. Assessing risk. Another principle from Buffett is to steer clear of companies with high levels of debt or those that often reduce dividends. These could be warning signs that might affect the stability of your portfolio. Instead, concentrate on businesses that have a robust financial structure and a history of weathering economic downturns successfully. Consistently evaluate your portfolio as companies can evolve and economic climates can fluctuate. Make necessary adjustments to ensure your portfolio remains in line with your financial objectives. By adhering to these principles, you can construct a robust dividend portfolio with the potential to offer a consistent income stream and assist you in reaching your financial targets. So, how do you make $1,000 a month from dividends? Let's dive in. Every stock you put your money into should constitute no more than 3.33% of your total portfolio. If each stock yields approximately $400 in annual dividend income, having 300 such stocks could result in an annual income of $12,000 or a monthly income of $1,000. So, to reach $1,000 a month in dividends, you would need around $240,000. $240,000 multiplied times the average yield of 5% annual dividend payouts is $12,000, which translates into $1,000 a month. For most of us, $240,000 is a lot of money. So, is there a faster route to getting $1,000 in monthly dividends? Covered called ETFs. Covered call ETFs is a type of exchange-traded fund that employs a specific strategy known as a covered call writing to produce income for its investors. In the covered call writing strategy, an investor offloads call options on a security they possess, receiving a premium in return. This premium, obtained from the sale of call option, serves as an extra source of income for the investor. How do covered calls work? Covered call ETFs operate by allocating funds into a variety of stocks and subsequently offloading call options on a segment of those stocks. The call option grants the purchaser the privilege, though not the requirement, to acquire the underlying stock at a predetermined price, referred to as a strike price, on or prior to a specific date known as the expiration date. The ETF, in return for selling the call option, receives a premium. So, how can you reach $1,000 a month more quickly investing in covered calls? Simple. Covered call ETFs have a much higher dividend yield, averaging 12%, compared to standard dividend stocks average about 5 to 6%. So, doing the math, you would only need $100,000 to reach $12,000 per year, aka $1,000 per month. So, you can see, covered ETFs is the investor hack to getting to $1,000 a month in dividends as quickly as possible. It's crucial to take into account risk factors, as ETFs with covered calls might have restricted potential for capital appreciation in comparison to conventional dividend stocks. Please remember that diversification and personal finance objectives should have a substantial influence in shaping your investment approach. And remember, please always talk to your financial advisor to customize your strategy according to your unique needs and risk tolerance. Whether you decide to leverage the strength of covered call ETFs with a 12% yield or prefer the conventional method of dividend investing, please bear in mind that your path to $1,000 a month dividends is not a quick race, but a long-distance run. The route you select should be in harmony with your financial objectives, risk acceptance, and investment timeline. Both approaches have their advantages, and the secret is to maintain patience, stay knowledgeable, and remain invested. So which technique strikes a chord with you? Voice your opinions in the comment section below. For more investment insights and strategies, subscribe and stay tuned for future updates. Thanks for watching.
Thanks for watching. See you next time.